In today's video, I want to touch on a very much forgotten growth stock. If you watch the portfolio video, you probably already know which company I'm going to talk about. I'm going to talk about Snap. Yes, Snap. Apparently, it's still a thing. Actually, it's a company worth $21 billion. Now, in the last 3 years, as you can see, the stock is still down close to 70%. Now, more recently, it's true that the stock has fared a little bit better. It's up 16% in the last 3 months. But the more important thing here is the business. What has the business been doing? And that's where the interesting part comes in. Because if we look at the analyst expectation for fiscal 24, 25, 26, top line growth, okay, quite solid. But the important part here is EPS. It's the bottom line growing extremely quickly. Of course, in fiscal 24, it's up 192%. That's because, well, in fiscal 23, there was barely any earnings. But then if you look at the next 2 fiscal years, it will grow EPS more than 50% in each of those years. Now, of course, right now you might say, oh, forward PE 34.5 times, that's quite expensive. Yeah, it's higher than Meta and Google, for example. But here you are getting over 50% earnings growth in the next 2 fiscal years. And that's why I'm making this video right now, because again, these are forgotten stocks. Forgotten stocks don't always equal bad businesses. No, there are lots of forgotten stocks, forgotten companies that have turned their business around. We've talked previously about Lyft, how they are turning their business around. Also another forgotten stock and forgotten company. And I'm not saying you should buy these businesses for the next 10, 20 years. No, these are businesses that are still, let's call them fragile compared to the other big ones that they're competing against, right? Lyft compared to Uber, and in the future, Waymo and Tesla and all of that. With Snap, it's of course competing against the likes of TikTok and Meta. But even when competing with the likes of Meta and TikTok, Snap continues to grow its user base. And that's quite impressive because me personally, of course, maybe that's just not my thing and my friend's thing because I don't know one person that uses Snap, but apparently their user base is growing. And yes, we all probably know by now what the biggest selling point of disappearing messages and images are. I see you. I see you. I know what you're thinking right now. And I mean, that's a big business, right? It's the oldest business in the game. So yeah, I mean, maybe that's how they're becoming more and more profitable. Who knows? Anyways, let's discuss Snap in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Right now, if you look at the average analyst price targets, it's true it's not that much higher than the price we're at today, only 4.12% higher. I do want to touch on another important thing before diving a little bit deeper, and that's the fact that net income is still quite negative. That will flip pretty soon. But the most important part, and that's something that I want to see continued decrease here, is SBC, stock-based compensation, as a percent of revenue. Now it's still extremely high in my opinion at 21.61% in the last 12 months. And well, I would like it to continue for much longer because it still is much too high. Looking at some pricing metrics, it comes at no surprise that we are lower than the 3-year mean, 4-year mean in some of those: forward PE, EV to EBITDA, price to sales, price to free cash flow. And so if we look at what this company is expected to do with regards to free cash flow, revenue we've seen, but what about free cash flow? Well, free cash flow in fiscal 24 is expected to grow close to 600%. Then in fiscal 25, another 112% growth. And then in fiscal 26, another 65% growth. So extreme growth when it comes to free cash flow. That's quite an important part because they can use that to then buy back even more shares and tackle the dilution problem. Looking at revenue growth in the next couple of quarters, for Q4, which is usually a pretty strong quarter, they expect around 14% growth year over year, and then 12, 13.5, 13, and 13 in the next few quarters. As I said previously, net income has been, net loss for quite a while, but that's expected to flip and flip quite hard in Q4 already. Then a dip in Q1 usually a weakish quarter, but as you can see, net income is expected to stay positive from here on out. And that's one of the catalysts I think we're going to see, is the fact that, oh, suddenly Wall Street is going to notice that this is turning into a profitable company. Looking at where they generate the majority of their revenue, we've got North America revenue, that's the big chunk. Then you've got Europe and rest of the world. Now we know from a monetization standpoint that North America and Europe 1 and 2, rest of the world, well, ARPU is not that high. They also told us that Snapchat Plus, that reached 12 million subscribers in Q3, more than doubling year on year, and that's growing extremely quickly. And this is basically why I researched Snap again. It's the fact that the daily active user, right? The average daily active user continues to go up. Now, of course, the biggest chunk here comes from the rest of the world. If you look at Europe, yes, it's true that in the last couple of years, it continues to grow quite nicely in the last couple of quarters, maybe not as quick as before, but that's fine. North America has basically been plateauing for quite a while. They also expect daily active users to be approximately 451 million in Q4. So another nice little jump here. And as I said before, if you look at average revenue per user, big part is North America, then Europe, then rest of the world. So of course, when you see the most lucrative part of their business, lucrative user base of the business not grow that much, yeah, it's maybe a little bit worrying, but as long as they do not lose a lot of those users, I think they'll be quite okay. And that has also been the problem with Snap, right? Throughout the years, it's the monetization part of things. Hopefully they figure their problems out. I mean, it's always been Snapchat versus Instagram, Facebook, but to be honest, you can't really compare one to the other, right? And I hope that they know right now that they're really not playing in the same leagues. Once they notice that, I think they could manage their business much better. They're also going to be, I think, a decent player in the AR industry, augmented reality, with their own glasses and all of that software behind it. I think they could be a decent player in that. So maybe that's a cool option. It's definitely maybe much better to be in Meta's situation when you can print billions and billions of dollars in free cash flow and work on multiple side projects. With Snap, they will have to focus on where they want to spend all that money on, because, well, as you've seen, not that profitable of a business. If we look at actually capital expenditures, if we look at gross profit, free cash flow, gross profit margin, we can see that CapEx has increased in the last couple of quarters. We can also see that free cash flow margin has improved. We can see that gross profit margin has stopped bleeding. So we have been plateauing at around 53% or so. Now we should expect it to go back up. We should expect free cash flow margin to continue its uptrend as well. Let's keep an eye on what's going to happen with CapEx. And so if we do a quick reverse DCF here using the free cash flow of the trailing 12 months, which is much lower than what, well, it's going to be for fiscal 24. So, okay, you already have to know that. So the implied growth rate is quite high currently at 30.3% to justify today's price. Now, of course, you can change the terminal growth rate. I just use the 10-year yield. I just use here this reasoning that Aswath keeps talking about. Of course, you can switch it. You can switch it to the 10-year yield. Then, yeah, the implied growth rate will be much closer to around 39% or so. But then if you start switching that, then you could also say, okay, then maybe I will use the free cash flow for fiscal 24. I mean, you can probably wait a couple of weeks and we'll get the free cash flow number. And that's probably going to be a bit higher than that. So the implied growth rate will be a bit more reasonable, let's say. But even at 30.3%, we've seen that in fiscal 26, free cash flow is expected to be what? $840 million or so approximately. If we look at it, what year with these calculations, what year they are expected to reach those numbers, that's between year 6 and 7. With what we've seen, that's already in 2 years from now, 2 fiscal years from now, they will already generate over $800 million in free cash flow. So just looking at this 30.3 and say, oh, it's a high number. Yes, it is a high number. But then again, if you look at how fast this company is expected to grow free cash flows, 30.3% is not that fast anymore. Finishing off by looking at the chart, we can clearly see that the stock did like to rebound around $8. We've seen also a couple of rebounds here around $10, and now we are making our way back up. We've made our way back up over the 200-day moving average, which sits at $11.85. We've had some solid momentum since September. I think most stocks have seen some solid momentum since September. So let's see if we can stay above that 200-day moving average. Earnings are expected to be here at the start of February. So what do you think? Do you think there is some hidden value to be found in Snapchat? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.